afternoon, everyone. It is 1 o'clock. We just got the closing bell for November 15th. We were expecting a muted session or a possible pullback. So let's see what actually happened during the day. All right, so we can see here that we said that as long as we traded between these lines that we marked in the morning, then we just consider that sideways chop. And we stayed there all day long. We didn't really get any good direction the entire day. Intraday, if we zoom in, it looks like we got some big movement, but really it just chopped sideways all day long. And we closed towards the lower end or near the lows of the day. So what does that look like on a daily basis? Well, so we see right here that we have a red bar, although the market is still up 0.21% versus yesterday. That is not significant. That's really just sideways chop. It does look like it is higher right here, but if I switch to a line bar or a line chart, you can see that it just barely moved. And what that's telling us is that it's petering out. It's slowing down. That huge rush upwards is slowing down. So that is helping us be more confident that we are actually maybe pulling back. We could just consolidate and chop for a little bit and then move up, but chances are pretty good we're actually going to get a pullback. I still believe that. I'm still going to say the same thing. I actually have even more reasons to believe that now that the day has gone on, but we just haven't seen that pullback quite yet. So if we look at yesterday's trade, let's see how that did today. Okay, we can see that there's a baby loss so far. If we look at the Microsoft, it actually went down 0.15%. It's just not that much. And so that's why we didn't get a gain on that option. But during the day, actually, if you watched it, it was in gain. It's just at the end of the market, spreads widened out. And so it looks like a baby loss on Microsoft. But you can see what I was talking about yesterday, whereas Microsoft is down 0.15% versus the overall market was up 0.21%. So Microsoft is still relatively weak to the market. And if the market pulls back, we should see Microsoft pull back even more than the market, or at the very least match the move downwards. So that's where we're looking at right here. We also see that we're still following that +3 ATR, and we really do expect a pullback away from that +3 ATR. That's what I'm looking at in the S&P 500 as well. We hit that +3 ATR yesterday, and we're still touching it today. We're just looking for that pullback away from the +3 ATRs. Even 2 years ago, when we saw that huge run up, the equivalent huge run up in the S&P 500, you can see that over here, I need to get the matching graph. Over here, okay. You can see that we ran up to the +3 ATR, stayed there for a few days, and then we pulled back to that +1 ATR. So that's what we're looking for. That's what we're looking for right here. Again, it doesn't have to be a big pullback. We're just looking for that pullback. Now, going counter trend, again, is a little risky and a little dangerous, and we have to be really quick and really nimble. Overall, if you don't want to be that quick, that nimble, and watch the markets very carefully, then you would still be long. I just noticed that's actually really interesting. The line that we drew over here, this line right here, the one that we needed to break out above, so that MA90 line right here, if I look all the way back, see how we reacted to it over here. This is exactly in 2021, the same time we had that big run up. And you can see these levels were matched over and over again. Hit it on the way up, broke through it on that big run that we're comparing it to right now, or we're comparing right now to. And then it pulled back to that same level, went back up, pulled through the level, bounced off of it, and then again, bounced off of it a couple times over here. So this level is a multi-year memory energy block inside the markets. That's really interesting. So this level is really important. And if we pull back to it, that'll be a strong support on the way up. But I was saying that if you didn't want to adopt the quick, nimble, hey, let's make a quick trade on the pullback, you would still be net long. And what you would do is you would find positions that are relatively strong to the market. So that means yesterday we had a nice huge jump up in a green bar. We were looking for the exact same thing in a stock if I'm going to go long right now. And an even stronger green bar than this one where it didn't really pull back. And then today, if I could get a green bar or an additional move higher, then that would be strong relative to the market. And those are what we're looking for. So because if we do pull back in the market, that relatively strong stock shouldn't pull back nearly as much. It may even be flat. And then when the market resumes its move upwards, then I'll move up stronger. If we don't get the pullback and we just consolidate, then it's relatively strong. It may still move higher, but if the market moves higher and we're relatively strong to the market, then that stock will take off. So if we're not going to play the pullback or the possibility of pullback, which is a little higher risk because it is counter trend, then we would just look for relatively strong stocks. So that's what we're going to do today, for our aftermarket trade. But let's finish taking a look at everything that's going on here and why I still believe that we are still going to get that pullback, although it might be minor and might be quick. But why am I still believing that? Even though I'm still starting to position my portfolios more and more bullish, I'm still looking for that quick trade on the pullback. So let's look at TLT. Bonds. Bonds did gap down and trade lower today, so that's putting pressure on stocks. If it continues to move downwards, then that'll put even more pressure on stocks. Or if it just chops, even if it just chops right here, if bonds don't give us relief in the form of moving higher, then it's going to limit how much the S&P can go up because there's no other catalyst in the market right now. We've got our economic news, we've got our CPI data. We don't have anything really happening in terms of earnings anymore. We don't have that many companies left, large influential companies, although we do have some. So we'll take a look at that next. But there's just not a lot of reasons for the market to go even higher. We already made up all those, or we already used up all those reasons over the last week and a half. So really, we're going to be watching for equities to queue off of bonds. And tomorrow, I'm going to be watching very carefully. Do bonds go down, or they go up from here, or they just chop sideways? So we said we look at potential earnings. So this is today after market. We've got Cisco and Palo Alto Networks. Those are probably the two biggest ones. So a couple of tech stocks. Sono, retail consumer electronics, maybe, but that'll give an indication on retail. And then if we have anything tomorrow before markets, we have Bed and Body Works. So that is retail. And Macy's, that's retail. We got Walmart. So we have some pretty important retail companies coming up between now and the open tomorrow. So we'll want to see what happens with those earnings, and that'll influence how we open up tomorrow and a direction that we might take. But net on net, we're expecting the move downwards. I already outlined all the reasons this morning and over the past week. But we had even more reasons yesterday afternoon and this morning. I'm going to add one more reason why it's looking a lot like we are going to get that pullback. And that is this right here. So market in and out is a service I use where I program my own criteria for it to alert me of things that are happening in the market. And so I just want to show you, based on my own criteria, what happened today. Today, right when we opened, I got two stocks signaling a bullish upward movement. Then I got a bear, a small, like three bull signals. And just look at the rest of the day. Bear, 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 all day long, not a single bull. And I can't remember last time I saw that. I don't think I've seen such a consistent run of alerts telling me about bearish opportunities without a single interruption with bulls. And it happened all day long. So that is giving me another reason to believe that we are going to pull back. And again, I'm not expecting a super big pullback really at this point. I'm just looking into that EMA 8, which lines up with the -1 ATR, or sorry, +1 ATR right here. So just a baby pullback right there before we can resume upwards. So I'm still have positions expecting that to happen, but overall we are bullish. This is a bullish reversal in trend. So let's take a look. Actually, what I want to look at is sectors. Today was relatively flat. I want to see what happened in terms of sectors. So where is money kind of washing around within the stock markets? So let's take a look at our sectors. Why can't I find my sectors? Sectors. And just today, I'm just so retail up most. So now that we're having earnings and we have that retail sales report, it looks like there's focus into retail. That is bullish for the market in general, just because retail is a more risky sector. But right next to it, we've got consumer staples. So we've got this fraction in the markets among the sectors. So, or fragmentation, I should say. I just said fraction. Fragmentation within the markets that is really, really unusual. It's one of the most conservative sectors up against one of the most aggressive sectors. So you can tell that there's still a lot of confusion in the market. And generally, what we need in order to clear up this confusion is a pullback to realign all of our sectors. Once we pull back and everything is kind of on equal footing ground, then the sectors can all rise again in the order of the normal growth, the normal speculation within the sectors. So we don't have that yet, but just this huge mixed bag of the sectors. Consumer discretionary kind of in the middle. We've got real estate in the middle. So interest rate sensitive ones are kind of middle of the road now. We've got B and I, industrials and basic materials, far from each other. So one in the middle, one near the top. And then we've got technology, far from retail. Got communications, far from technology. Everything is all over the place. We've got silver at the very top and gold at the very bottom. Everything is just out of whack here. And that tells me that we need a pullback in order to get everything realigned. So retail is definitely in focus. So let's see if we can find a relatively strong stock, especially if it's in retail. And I'm going to limit it to the S&P 500 and QQQ. I'm not really going to be interested in small cap stocks until I see strength in it. And I'm not really going to be super bullish in small cap stocks unless I see small cap stocks starting to lead. We did bump up against that MA 200 today. So we did get a huge amount of strength yesterday, but no follow through today. So this will be interesting to watch if it can move up. If it can move up above that MA 200, then that could start to run, and we would definitely change our opinion on the S&P 500 moving upwards. But so far, right now, not looking like it's going to do that. Might consolidate or pull back at this point, which would coincide with the S&P 500 pulling back, and then we'll see. Maybe this can run. So let's take a look at a potential long. So relatively strong versus the S&P 500. And Expedia, they must have had earnings. That's a huge move upwards. Definitely relatively strong. Let's take a look at that. No, they did not have earnings. They had earnings a little bit ago. So this is a huge move upwards. Breakout. So yesterday, so this is something that we'll want to watch. So you made a new high. Yesterday it matched new high. Today it broke out with a gap up and a momentum surge upwards. That is really strong. However, we are at that +3 ATR. This is a very bullish move, but a little too much too fast. So this is something that we would watch for a pullback. And if we pull back, this will be an excellent stock to go into. Okay, so this looks good. We just have to wait for the right entry. Adobe, but down today. NRG. NRG I have in one of my portfolios. Energy and Netflix, although Energy is looking better. Energy is relatively strong. AVGO is relatively strong. Energy is utility. AVGO is a semiconductor. Let me see retail. Let me limit it to retail. I don't know if they have retail. It might be discretionary. 35, they do. Interesting. So EXPE showing up again. Chipotle off of a huge run though. MELI, Mercado Libre. Very strong. I kind of like MELI. Ross Stores, Costco. Costco, Walmart. Walmart has earnings tomorrow. Costco. TJ Maxx also had earnings today. Oh, and it pulled back down today. I missed the latest bar. Starbucks, Costco, Mercado Libre. Darden Restaurants, but it's just barely getting above its moving averages. So this is an interesting one to look at. Home Depot gapping up, still below a lot of moving averages, so not going to look at that one. And now we're looking into more bearish looking stocks. So let's take a look at Starbucks, Darden Restaurants, Costco, and Mercado Libre. Very strong up against its +3 ATR, but still relatively strong to the S&P 500. Now, I'm not going to freak out because remember the purpose of this. All I'm looking for is a relatively strong stock versus the market. So if the market pulls back, sure, this might pull back as well, but it won't pull back as much. So for example, if I pull back to the EMA 8 right here, what's the distance to the EMA 8? That is not even $2.65. $2.65 is barely over 1 ATR. ATR is 2.01 right now. So it's barely over 1 ATR. If I look at SPY and I pull back to the EMA 8, the EMA 8 is at 440 versus the current level at almost 450. So that's almost 10. We'll call it 9.3, 9.5. And look at the ATR though. The ATR is 5.11. So that's almost 2 ATRs. So what we're looking at is relative to the S&P 500, we would expect Starbucks to only drop by half as much in terms of the normal volatility. So Starbucks is definitely strong to the market. And if we do pull back and everything pulls back, I'll lose half as much in Starbucks than I would if I had entered the market. So that means it's stable. It's a safer bet for me. But if the market moves up, they're going to move up. Since I'm already relatively strong to the market, I expect a bigger move than the market. So it's half on the way down, but multiples on the way up. So we wouldn't apply the same. This is like, where do I have resistance? Where do I have support? So that EMA also happens to be this horizontal support right here. So I've got a lot of horizontal support that I didn't have in the S&P 500 because the S&P 500 gapped. So the horizontal support for the S&P 500 is all the way down a little bit below the EMA 8. So when I see the Starbucks is relatively strong in that way, I can drop half as much on the way down, but on the way up, I should do at least as much as the market. Starbucks is looking really great right here. So I'm not looking for something that will still make money if the market moves down. I'm just looking for something that won't lose as much money if the market goes down. But if I'm wrong about the market going down and it goes up, then I'm looking really, really good, right? Or the market moves down like we anticipate and we have a small pullback. When it bounces, Starbucks is going to move up a lot more than the S&P 500. So Starbucks is looking really good. Let's look at Costco. Costco is looking really, really strong. Let's see that move right there, 597 versus 579, so about 18. So it's about the same on the in terms of a ATR drop, and we are only just barely hit the +3 ATR versus on Starbucks, we've been there for a little bit. Liking Costco more than I like Starbucks right now. We had Mercado Libre, MELI, and then I'm blanking on the fourth one that we wanted to look at. Costco, Starbucks, Darden Restaurants. So MELI, we got plus 0.84. I don't like that. We got the red bar, same as the S&P 500, so it's not super strong relative to the S&P 500. We are only just barely hitting the +3 ATR. We're actually a little bit below it in terms of where we closed. So not as much resistance to upside as I would like and not as much as Starbucks. So definitely preferring Starbucks over MELI. And let's look at Darden Restaurants. Darden Restaurants, it just has this super long downtrend without any really distinct bounces or highs. So it's just down, sideways, down, sideways, down, sideways, down, sideways. There's no down and then up. It's all down then sideways until we finally break that over here. And so it's very difficult for us to find any good levels to compare to and say, this is resistance. This is other than these flat tops. But what I mean by that is I don't get a good handle of levels where this can bounce off of. What I do see, though, that is encouraging is that we've got this general trend happening right here. This is about a halfway move, but we did get above all the moving averages. So if we pull back, there is at least this support right here, a little bit below the MA200. So I have the MA200 and this horizontal support right here to limit my downside. So bouncing is a pretty good possibility right here. Well, we are just entering the +3 ATR. And yeah, not liking it as much as Starbucks. But out of all the four we picked, Darden is my number 2. So it's still relatively strong to the S&P 500. When I look at on a individual day basis, if I look at this overall pattern, it is definitely weak to the S&P 500. So if I was going to go into Darden Restaurants, it would be on a very short-term basis. It wouldn't be trying to capture the new change in trend in the S&P 500. Sort of like here, the new change in trend. We didn't get that in Darden Restaurants yet. There's no clear distinction that Darden Restaurants has changed its downward trend, other than it got above the MA200, and we have 2 full days above the MA200. That's very encouraging, but I could easily draw this, right? It down, roughly 50% retracement, then back down. So it's not as strong as the S&P 500. So that's why if we did Darden Restaurants, it would be very limited. It would be in terms of the time frame. So Starbucks is looking great. It's looking like the best candidate right here. And so we could go in the aftermarkets, look at Starbucks. And because I want protection to the downside, I don't want to just go right at the money. I'm going to go a few strikes down into the money. And that way I don't lose as much if it goes down, but I can still participate if it goes up. So normally I like the 1% extrinsic value. I don't have a great or quick way in using the current tools. I would have to open up my brokerage account and take a look at an options table in order to pinpoint exactly, but I could just say $1.06 in extrinsic value. So let's say 95, if I paid 38 for it, we got 106 minus 95, that's about 11. Oh, sorry. Yeah, about 11. So 13. So this is way over 1% extrinsic value. Yeah. So we'd have to go further down. So let's just say if we move, what was one ATR move was about $2. So about 2%, a little less than 2%. If I move down 2%, so we'll call that down to about 98.5 or 99. If I move down to, this is a put, I need a call. So if we move down to 99, $2 move. What I'm saying, $2 down. If I move $2 down from 106, so I move down to 104, then I'm down $185, which is less than 15%. And if I move up that same $2 to 108, then I'm up 184, so about the same. Yep, about the same, 1-to-1 reward risk ratio. So that'll do, let's let's just say 85. So I'm just going to say for a $1 move up, if I move to 107, then we move up 90 cents. So about $1. So this is actually a really high delta right here. So maybe I don't want 85, maybe I want 90. Let's go. If I move up $1, then I move up 86 cents. So that's about an 86 delta. I'm probably looking for roughly 70 to 75 delta. This one's still 85 delta. Take 100, about 77 delta. That's pretty good right there. So we're going to go with the 100 call in this example out to January. It's okay. We can do out to January. So I will save this trade. This will be the aftermarket for today. Okay. So hopefully you get to see how we're thinking about this, right? So I think about if I'm wrong or if I'm correct and we pull back to the downside, I want to limit my losses. If we go sideways, or we go sideways, then we just go sideways, where our losses will be limited anyways, just limited to the loss of time value. And we chose a January option, so the loss of time value is minimal because it's still really far out. And then if we go up, we are relatively strong to the market, and so we'll participate in that. So limited on the downside, basically flat on sideways, and then an oversized profit potential versus the market if we go upwards. So in this way, this is how we're going to stack the probability expectancy in our favor and create an edge inside this particular trade. So hopefully that showed you a new way or a different way of looking at how you're picking trades. And we went through quite an extensive process of actually looking for a stock that is strong relative to the markets and comparing a few different possibilities versus each other on why we would choose one over the other. So this is one you might want to repeat and look at and go through that thought process again. So that's it for today. I will see you guys tomorrow and we'll see how we open up. We'll see if we start getting that pullback. All right, guys, I'll see you in the pre-market tomorrow.